You are listening to Uranium Spotlight on Tuesday, April 1st, 2025. Brought to you by Purepoint Uranium Group, your exploration partner in the most prolific areas of Canada's Athabasca Basin. With a collaborative investment model on district-scale projects and validation from industry leaders Cameco, Orano, and ISO Energy, Purepoint is investing in Canada's uranium future. And now your host, Chris Frostad.
This week on Uranium Spotlight, the U.S. supports India's nuclear advancements, while Paladin's setback adds to the market's uncertainty. Last week, the uranium spot price slipped by 25 cents to $64.45 a pound U3O8, retreating slightly from the previous week's $64.70 close. Despite the dip, all four major indicators, UxC, Cameco, Orano, and Coverdine, held steady throughout the week, reflecting extremely low market activity. This stability amid a mild price drop points to a market still lacking meaningful spot demand, particularly from U.S. utilities that remain largely on the sidelines amid ongoing tariff uncertainty. Yet what's most notable for equity investors is that the long-term uranium price remains unchanged at $80 a pound, reinforcing a continued disconnect between the spot and term markets. That gap matters. While the spot market can be influenced week by sentiment or lack of liquidity, the term market is what drives producer economics, and it's holding firm. According to UxC's recent market survey, many utilities see $80 as an acceptable level to support future production, while producers continue to argue it's not high enough to incent new supply. Either way, there's little expectation of significant term price declines in the near term, even with spot prices drifting. For uranium equity investors, the message is clear: spot market softness doesn't signal a reversal of fundamentals. With carry trades likely to increase and more utilities expected to re-enter the market later this year, especially as trade policy becomes clearer, the current pause may simply be the calm before renewed spot market tightening. The U.S. Department of Energy has authorized Holtec International to transfer its reactor technology and know-how to Indian firms Larsen & Toubro, Tata Inc., and Holtec Asia. These companies will use Holtec's designs to develop and build small modular reactors, or SMRs. SMRs are often promoted as a faster and more cost-effective alternative to traditional large-scale nuclear reactors. However, their commercial rollout still faces hurdles, particularly with lengthy regulatory design approvals. That said, this agreement signals serious intent from both nations to push forward. Notably, these SMRs won't follow India's traditional pressurized heavy water reactor, or PHWR, design. Instead, they'll be based on light water reactor, or LWR technology, the global standard used widely in the US, Europe, and Asia. Switching to LWRs opens up India to global supply chains for fuel and components, while sidestepping the need for heavy water processing. Strategically, this deal is being viewed as a diplomatic win for India. Despite rising U.S. protectionism and reshoring push, India has secured rights to manufacture American-designed reactors, something that would have been unthinkable not long ago. Just weeks ago, Washington and New Delhi reaffirmed their commitment to fully implement the 2007 U.S.-India Civil Nuclear Agreement, known as the 123 Agreement. This appears to be the first tangible step in that direction. Under this partnership, Larsen & Toubro, India's engineering powerhouse, is expected to produce reactor components, while Tata will likely lead development and operations. Holtec remains the technology provider. It's a remarkable turnaround. For decades, India was isolated from the global nuclear market due to its weapons program and non-signature of the Non-Proliferation Treaty. Until the 123 Agreement, it was effectively building its nuclear program in isolation. While Russian technology has been used in Indian reactors, U.S. technology has been entirely absent until now. So even as the U.S. becomes more inward-looking on trade and energy policy, this deal allows India to manufacture next-generation reactors with American designs and global supply chain integration. For uranium investors, this could mark the beginning of a long-term ramp-up in Indian nuclear demand and a signal that U.S.-designed SMRs may have a broader global market than previously assumed. Paladin Energy has now resumed operations at its Langer Heinrich uranium mine in Namibia after weather-related disruptions. The extreme rainfall has subsided, but the aftermath continues to affect the site. Key mine roads were damaged, ore stockpiles were waterlogged, and access to the site remains difficult due to washed-out connecting roads. Thankfully, there are no injuries, and the processing plant itself remains intact. While some peripheral infrastructure suffered minor damage, the plant is being brought back online and efforts are underway to dry out and process the saturated ore. The bigger story for investors, however, is that Paladin has now withdrawn its 2025 production guidance entirely. Even before the storm, guidance had already been revised downward. With no updated forecast in place, the market is left with greater uncertainty around global uranium supply for the year. But one thing seems clear, it's unlikely Paladin will hit the 3.0 to 3.6 million pounds of U3O8 originally projected for 2025. This adds further pressure to a market already characterized by tight supply. If U.S. tariffs on imports come into play, they could push prices higher, particularly as Washington ramps up trade tensions with key uranium-supplying nations. Global inventories are gradually being drawn down, and while spot activity remains relatively quiet for now, this dynamic could shift quickly if buyers step in later in the year to restock. Some market watchers have suggested that we're entering a buyer's market as prices pull back. Others argue that supply fundamentals still dominate, and there simply isn't enough new production online to meet rising demand. The reality likely lies somewhere in between, especially given the long lead times and regulatory complexity that new uranium projects face, not to mention the relative inexperience of many new entrants to the sector. Paladin's experience with what is called a once-in-50-year rainstorm also speaks to a broader growing risk, climate volatility. As extreme weather events become more frequent and severe, the costs and operational risks for miners are rising. And this isn't just an operational concern. Climate-linked instability can worsen fragile political environments, as seen in Niger and Kazakhstan, where geopolitical risks have already disrupted uranium supply. By contrast, Saskatchewan's Athabasca Basin offers a more stable and secure setting. Since the 2007 flooding of Cigar Lake, the region has enjoyed relatively stable weather, and Canada's regulatory environment has become more supportive. The recent elimination of overlapping federal and provincial mine approvals is just one example. As the richest uranium-producing district in the world, the Athabasca Basin remains one of the safest bets for most producers and investors. Homeland Uranium continues to build momentum as a newly listed U.S.-focused uranium explorer, now trading on both the TSX Venture under the symbol HLU and the Frankfurt Exchange as D3U. Following its recent reverse takeover of Shift Rare Metals, Homeland has hit the ground running by significantly expanding its land position in northwestern Colorado, staking 505 new mineral claims adjacent to its flagship Coyote Basin and Red Wash projects. This brings Homeland's total footprint to over 33,000 acres across Moffat and Rio Blanco counties, an area with historical uranium occurrences and host rocks considered prospective for front roll and tabular-style deposits. Notably, the expanded Red Wash project now includes a 1970s-era uranium showing with outcrop samples grading 350 ppm U3O8, suggesting exploration targets are not just theoretical but supported by legacy data. Importantly, these claims fall under the terms of the Shift amalgamation, which includes milestone payments tied to future resource definition, specifically 2.2 million shares and $111,000 in cash for every 5 million pounds of uranium defined, capped at 45 million pounds. That incentivizes early resource definition and makes near-term exploration news particularly relevant to equity holders. CEO Roger LeMaitre, a veteran in uranium exploration, says the company is now laser-focused on advancing both Red Wash and Coyote Basin toward resource delineation. For uranium investors tracking U.S. supply stories, Homeland is positioning itself as a potential new entrant in the domestic uranium narrative, with a clean share structure, exploration catalysts ahead, and a strategic land position. And that wraps up your Uranium Spotlight coverage for this week. For more news and events from the world of uranium, please tune in next week to Uranium Spotlight.
You've been listening to Uranium Spotlight, your weekly podcast dedicated to delivering the latest news and events shaping the uranium fuel market and its critical role in the global energy landscape. Brought to you by Purepoint Uranium Group. Purepoint actively operates a portfolio of advanced uranium projects in the world's richest uranium district and has established partnerships with industry leaders. While our passion for this subject is undeniable, it's essential to clarify that the information presented here is not investment advice. Instead, Our goal is to offer an unbiased and comprehensive review of recent events that could impact uranium prices. Join us again next Tuesday for Uranium Spotlight.